Welcome to The Explainer. Today, we're going to dive into the core ideas from Howard Marks's incredible book, Mastering the Market Cycle. The goal? To figure out how we can stop guessing and start getting the odds on our side as investors. Look, when Warren Buffett says he always learns something from you, the entire world sits up and listens. This isn't just some casual compliment. It's a huge signal that Howard Marks' way of thinking offers a profound edge for anyone trying to figure out the market. So let's see what we can learn. So here's our game plan. We're going to follow a kind of hourglass shape. We'll start big with the main idea, what the real investor's edge is. Then we'll narrow down to the two core mechanics that drive everything, psychology and credit. And finally, we'll broaden back out to a really practical tool you can actually use. All right, first up, the investor's edge. So what's the actual key to success in investing? Is it what most of us think it is? This is the question that just about everyone is obsessed with, right? We're all looking for that crystal ball, that one perfect forecast that's going to tell us exactly what happens next. But Howard Marks is really clear on this. That crystal ball, it just doesn't exist. And this is the huge mental shift he wants us to make. The best investors, they don't claim to know what the future holds. What they do have is an exceptional, above-average understanding of what's happening right now. And from that, they get a much better sense of what's likely to happen next. So the key word here is tendencies, not certainties. Think of it like this. You don't know exactly which lottery ticket is going to win, but a superior investor has a really good sense of how many winning tickets versus losing tickets are in the bowl at any given time. By understanding where we are in the cycle, we can figure out the probabilities and, start tilting the odds in our favor. Okay, so let's dive into the most powerful force driving all of this, human emotion. This isn't some fuzzy side note. For Marx, this is the very engine that pushes markets to their wild extremes. And to explain it, he gives us this absolutely brilliant metaphor of a pendulum. It's always moving, always swinging from one emotional pole to the other. And here's the most important part. It spends very, very little time just resting in the middle at that rational, happy medium. And you can see those two extremes mapped out right here. On one side, you've got total euphoria. Greed is running rampant, everyone has a fear of missing out, people become incredibly tolerant of risk, and they'll believe pretty much any story they're told. Then, on the other side, you've got depression. It's all about fear, risk aversion, and a fear of losing money. Skepticism is so high that even fantastic opportunities get ignored. And if you think that sounds a bit dramatic, get this. In nearly half a century of data, the S&P 500's return was considered average only 3 times. Just 3. That just goes to show you, the average is actually the rarest thing of all. The market lives at the extremes, and it's all powered by that wild psychological pendulum. Now, psychology is the engine, right? But that engine needs fuel. And that brings us to the second major driver of these cycles, the availability of money, or what Marx calls the credit cycle. So if psychology is the engine, credit is the fuel. This cycle basically decides how easy or how hard it is to get your hands on capital. And Marx describes it like a window. Sometimes it's wide open, just pouring money into the system. Other times it gets slammed shut in an instant, starving the system of cash. It's this volatility that can turn a boom into a bubble and a bust into a catastrophe. And the scary part is, this isn't random. It's a chain reaction, a domino effect, where each step directly causes the next one. Good times make people lend more, which leads to foolish lending. Those bad loans eventually cause huge losses, which of course makes lenders terrified, so they slam the brakes on lending, which kills the prosperity, and then the whole cycle starts all over again. But here's the flip side, and this is absolutely critical for any investor. This is where the greatest opportunities are born. When that credit window slams shut, when money is the hardest to find and fear is at its absolute peak, that's when unbelievable bargains pop up for the very few people who are actually prepared. Okay, so that brings us to the big finale. We've got the theory down, right? But how do we actually use this stuff? How do we put all this knowledge into practice to get the odds in our favor? Well, his advice is so simple, but it's incredibly powerful. He says, forget about being a fortune teller, instead become a doctor. Your job is to simply take the temperature of the market. By just observing a few key things that are happening right now, we can get a really clear diagnosis of where we are in the cycle. And this table, this is basically your diagnostic toolkit. It's your thermometer. Just look at the contrast. When the market is hot, you're at a peak. Lenders are eager, money is loose, investors are optimistic, prices are high, which means future returns are going to be low. The exact opposite is true when the market is cold. But look at that last row. This is the most important insight of all. At the peak, when everything feels great, the actual risk is high, but it feels low. And at the bottom, when everyone is terrified, the actual risk is low, but it feels incredibly high. And that brings us to maybe the most important contrarian idea in the whole book. The most dangerous time in any market cycle is the moment when everyone believes risk has just disappeared. That feeling of universal comfort? That's the ultimate red flag. And who better to sum up the right way to act than Warren Buffett himself? He says, the more reckless you see other people being, the more careful and disciplined and prudent you should be with your own affairs. It's that simple. So we're going to leave you with that framework and one final question to really think about. Look at the world around you, check out how lenders and investors are behaving, listen to the stories being told in the news, and then ask yourself, using these tools, what's the market's temperature right now?